This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by
TheStreet.com. Interactive financial multimedia tools for an ever-changing financial world. Our Dividend Stock Advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
A tsunami of change from New York to Tokyo and across the globe. The world's biggest markets seem to be undergoing a major shift that could impact everything you own, from stocks to bonds and commodities.
A 2-second head start. That's all it takes for some traders to get an edge over you, the individual investor. And that's exactly what's happening when a closely watched market-moving report is released every month.
And distracted drivers. A new study says it's not just about taking your eyes off the road, but also your mind. We have all that and more tonight on Nightly Business Report for Wednesday, June 12th.
Good evening, everyone. For most of 2013, we've begun this program with talk of record highs and winning streaks for stocks. Tonight, it's a losing streak, the first 3-day stretch of losses for the Dow so far this year. And the losses have not been small. Today's nearly 127-point Dow decline followed yesterday's 117-point drop and was the fourth triple-digit loss for the Dow in 2 weeks. Investors are increasingly worried that a big multi-year change is taking hold. It's not just concern that the Federal Reserve may pull back on its bond buying program, sending interest rates higher, though they have risen sharply since early May, including today. It's that China's economy may be slowing, pulling down emerging market countries with it. Emerging market stocks off 10% since their peak in May. Brazil's market down 20%. Japan and Europe aren't out of the woods by any means yet, and the big asset manager PIMCO says there's a 60% chance of a global recession in 3 to 5 years. Adding to Wall Street's worries, the dollar index, which tracks the strength of the U.S. dollar against a basket of currencies, touched its lowest level in 4 months today. At the end of another exhausting day, the Dow finished down more than 126 points, ending below the 15,000 threshold. The Nasdaq, 36 points lower, and the S&P 500 off by 13.
So what do all these global developments mean for your investments and your business? Joining us now to talk about all this, David Kelly. He's Chief Global Strategist at J.P. Morgan Funds, and Ira Jersey, Director of U.S. Interest Rate Strategy at Credit Suisse. Gentlemen, welcome. Ira, let me begin with you and just ask you that, do you agree that we are entering some kind of new era, and how much risk is the global economy really facing?
I don't think you could say we're in a new era quite yet. I do think that the market's getting a little bit ahead and a little bit shaky, thinking about what policy changes might be in store. You saw a lot of volatility yesterday after the Bank of Japan did not give you more information about what their end goal was for their current policy of their own bond buying program. And the market has really been on edge the last month or so concerning whether or not the Federal Reserve will continue to its own bond purchase program. In fact, the way that we view it, the market is actually pricing in for a very bad policy mistake by central banks, not only in the U.S., but indeed globally.
David, is the market overdoing it, as Ira suggests there? In other words, are they pricing in the possibility not just of a tapering, but maybe of a complete canceling of the bond purchases? And why are the emerging markets taking it so hard?
Well, I think two things. First of all, I think there are some genuine economic problems in emerging markets. China is growing more slowly, and you can see an inflation problem in India. You've got a bit of an inflation problem in Brazil, too. So there's some growing pains there. But in the long run, I think emerging markets will grow more quickly than the developed world anyway, and I'd want to have some assets there. Well, overall, I think markets have been going up very strongly, particularly in the United States in recent months. They're due for a pullback. You can never time exactly when that's going to happen, but I think that's what's going on. But fundamentally, I don't believe that rising interest rates threaten the U.S. economy. I think the U.S. economic expansion, it's like a tortoise, it's not a hare, but it's a very steady tortoise, and I think it will continue to grow through rising interest rates. And because of that, I think long-term investors should still be overweight equities, underweight fixed income as interest rates rise.
Well, let me ask you more about that, David, in terms of what should investors be doing to prepare themselves for higher interest rates. For the longest time, all year long, even last year, money managers everywhere were saying time to get out of bonds and put more money into equities, and we haven't seen that so-called great rotation happening. Is now the time? I mean, what are you doing with client portfolios?
Well, I think the important thing is not to try and time it too precisely. We don't know, but what we do know is that interest rates are too low for a recovering economy. Gradually, the unemployment rate is coming down in the United States, and as the Federal Reserve continues this policy of QE, it's getting to be a bigger and bigger balance sheet, which is going to be more of a problem when they try and reverse things. Because of that, they are going to eventually taper QE and eventually bring it down to zero accumulation, and that is a big change, and that will push interest rates higher. So the key thing is, don't try and time this, but position your portfolios correctly today for higher interest rates. And that means not only being a little overweight equities, a little underweight fixed income, but also within equities, a little overweight those less interest-sensitive sectors like technology, and be a little light on things like utilities. Within the fixed income market, overweight things like high yield, convertibles, floating rate, underweight things like treasuries and tips, and high-quality corporate bonds, which tend to get hurt when interest rates rise.
So, David, David has given us a wonderful smorgasbord of possibilities there. He says overweight equities, but what if you're not? What if you're overweight bonds? Bond yields have been rising dramatically. When people get their end-of-quarter statements, I suspect that some of them are going to be quite surprised. What should I do if I am overweight bonds and mortgage-backed securities right now?
Well, we agree with David's premise. In fact, in our model portfolio, we're underweight treasuries, and we're underweight the long end of the treasury market in particular. So we have shortened duration. We're more buying 2-year, 3-year, 5-year bonds instead of 10-year and 30-year bonds. And we do like corporates. I think, there are things like investment-grade corporates. You can get some quality names with some spread, and by buying those instead of treasuries, for example, you can pick up some incremental yield. I do think that the market that you've seen over the last couple of weeks, though, does present a big problem, and I think this is an important point. And that's that Wall Street cannot warehouse as much risk as it used to be able to. So things like bid-offer spreads on a lot of bond market products, so things like corporate bonds, like high-yield bonds, and like mortgage bonds, have widened quite substantially because Wall Street balance sheets are much smaller. So the amount of bonds that they can buy in these sell-offs is more limited, and because of that, you're going to wind up seeing much more volatility as risk gets taken off of portfolios by money managers.
I'm sorry to cut you off. We're just going to have to leave it there. This is a complicated issue. You did bring some clarity to it for our viewers tonight. Thank you, gentlemen, both so much. David Kelly of JP Morgan Funds and Ira Jersey of Credit Suisse.
Well, despite the recent slide in the markets, the Business Roundtable, a group of American CEOs from some of the nation's largest companies, is more optimistic about the economy. In its latest survey of chief executives, a third of its members expect to take on more employees over the next 6 months, and nearly 80% of them expect sales to increase during the same period. The group also credits steady consumer spending for the modest growth in the economy this year.
Shares of Hewlett-Packard were one of the day's bright spots, jumping more than 2.5%. And those gains were driven by upbeat comments from its CEO. Meg Whitman, now a year and a half into her role as chief executive, predicts that despite a sharp drop in personal computer sales, revenue at HP could grow over the next year thanks to software servicing, printers, and computer sales.
This is going to be a 5-year turnaround to get HP running just like it should, for a company of this iconic status. But as I said, you don't have to wait 5 years for results. And I'd say we're just a bit ahead of where we thought we would be. We're about 18 months into this 5-year turnaround, and we're about right where we have to be. We got a long way to go.
HP shares have more than doubled since November. And Cisco is also looking good thanks to the massive growth of internet traffic. The network equipment maker is predicting that a new computer router product it unveiled today will boost revenue 25% to $10 billion within the next 2 years.
Shareholders at Caterpillar and Target have something to smile about. Dow Component Caterpillar, the world's largest maker of earth-moving and mining equipment, is raising its shareholder dividend by 15% to 60 cents a share. And retailer Target is doing them one better, raising its payout to shareholders by 19% to 43 cents a share. Well, some encouraging news about housing. Despite mortgage loan rates edging up to a 15-month high last week, applications for new mortgages and refinancings rose 5%, according to the Mortgage Bankers Association. So, are rising rates prompting prospective home buyers to get off the couch and start hunting? For that story, log on to our website, nbr.com. And there was good news about so-called underwater homeowners, people who owe more money on their mortgages than their homes are worth. Many of them are now above the waterline. The real estate tracking firm CoreLogic reports that the number of underwater homeowners has dropped below 10 million for the first time in about 3 years. That's down from 12 million at the start of 2011.
Well, along with those rising home values, Americans are also seeing a big boost in their 401k retirement savings accounts. Investment manager Vanguard reports that thanks to the rising stock market, average retirement savings account balances rose 10% in 2012.
Well, in a prime example of how challenging it is for individual investors to get a fair shake, we're learning that some Wall Street traders are paying to get early access to selected market-moving data every month, and it's all legal. Eamon Javers has been following the story and joins us now from the nation's capital. Eamon, who are the major players in this story, and how are traders getting that head start?
Well, good evening, Tyler. CNBC has obtained a document that shows that closely watched consumer confidence number that routinely moves markets is accessed by an elite group of traders for a fee a full 2 seconds before its official release. A contract signed by Thomson Reuters, the news and data feed service, and the University of Michigan, which produces the widely cited economic statistic, stipulates that the data will be posted on the web for the general public at 10 a.m. on release days. 5 minutes before that, at 9:55 a.m., the data is distributed on a conference call for Thomson Reuters paying clients who are given certain headline numbers. But the contract carves out an even more elite group of clients who subscribe to the ultra-low latency distribution platform, or high-speed data feed, offered by Thomson Reuters. Those most elite clients receive the information in a specialized format tailor-made for computer-driven algorithmic trading at 9:54:58.000, according to the terms of the contract. Now, here's what Thomson Reuters told us about this early release. Thomson Reuters saying details of the tiered release of this data are provided openly to Thomson Reuters customers and to the wider public, and anyone wishing to trade on this data can pay for the service that best meets their data needs. Now, Thomson Reuters also said it fully discloses the 2-second lead time on its website. And guys, I can tell you, this is extremely valuable data. The contract shows that Thomson Reuters pays the University of Michigan at least $1 million per year for the exclusive right to distribute it. Back to you.
So, Eamon, you talked to Thomson Reuters. What about the University of Michigan? I understand that you talked to them as well. What was their reaction to all of this hullabaloo on this subject?
Yeah, well, they told me that they believe that this has been carefully vetted, this contract, and it follows all regulations and rules in this area. And the person who actually puts this data together told me that because it's privately financed by Thomson Reuters, he thinks that they wouldn't even be able to collect this data or distribute it to the public at all if they didn't have this private money coming in.
How much does Thomson Reuters charge for access to this data, especially the early access?
Well, they wouldn't tell us. We know that they pay $1 million a year to the University of Michigan, but Thomson Reuters would not tell us how much they're charging their own clients for access to that information. Presumably, they're making more than $1 million a year on it, or else it's not a good business.
All right, Eamon Javers reporting from Washington tonight. Thank you very much. So what do you think? Is this fair or unfair? Send us your comments at nbrmail@cnbc.com.
Still ahead on the program, not only is Amazon moving into the grocery business, but it's also competing for a lucrative contract with the CIA. We have details coming up. But first, a look at how some of the most widely held stocks closed today.
A couple of big moves in different sectors in Market Focus tonight, starting with Health Management Associates. That company's shares hit a 6-year intraday high today before easing off. Its largest shareholder, the hedge fund Glenview Capital, has petitioned the SEC to get HMA to eliminate or ease the provisions of a so-called poison pill anti-takeover defense. Shares of Health Management, up more than 11% today, have more than doubled over the past year. Spectra Energy, a natural gas distributor, jumped double digits today as investors see its corporate restructuring leading to higher dividends down the road. Spectra shares traded at 4 times normal volume, closing at $33.68, up more than 11%.
After the market close, a huge deal was announced, a Safeway saying the sale of its Canadian operations for more than $5.5 billion in cash. Shares of Safeway have been down a fraction of the regular session, but then rocketed higher on news of the deal. Masco was a gainer today after bullish comments by the company at a bank conference. Masco's companies make products that are sold at Home Depot and Lowe's. Shares gained more than 1.5% to $19.88. Shares of Boston Beer bubbled up today after Goldman Sachs raised its rating on the stock to neutral. Goldman said it significantly underestimated the success of Angry Orchard. This is a hard cider that's flying off the shelves. Boston Beer also brews Sam Adams. Investors raised a glass to Boston Beer, shares gaining 5.5% and up more than 51% in the past year.
Well, the recent reports about the U.S. government hiring private companies to do intelligence gathering and what then happens when the wrong people get access to sensitive data has seemingly not deterred some of the nation's biggest companies from competing for those lucrative Washington contracts. John Ford has more now on a computing deal with the CIA that's garnered a lot of attention, and it's pitting Amazon against IBM. So, John, what's the significance of companies like Amazon getting into the cloud computing business with the government?
Well, Tyler, in this deal in particular, it's a CIA contract. And just so that everybody's got this in perspective, it doesn't mean that the CIA is doing its work in intelligence gathering on Amazon's public cloud. This is more about consulting to figure out how to build kind of a private cloud inside the government for the CIA. This is traditionally the sort of work that IBM would have done. They're a lock for that sort of thing. They know about security. They're in tight with the government. This time, Amazon at least initially won the contract, and IBM has challenged that. It just shows how this move toward the cloud is shaking up the traditional structure of who gets these government contracts.
So, John, tell us a little bit more about the impact on companies like IBM.
Well, for IBM in particular, this is a tricky situation. The Smarter Planet initiative that IBM has is largely based on the idea that they've got these relationships with governments. They can pull a lot of different data, information in, and then predict what's going to happen next, be a lot smarter about delivering software, delivering services to customers. If you get some upstarts like Amazon coming in, taking in some of that first order business and constructing the cloud, it makes some of IBM's other businesses like software potentially weaker down the line.
I got to say, John, that the whole idea of a private cloud sounds a bit like an oxymoron to me. But does this mean that the most conservative tech customers like the CIA are getting more comfortable with putting data, information up in the cloud?
In their own private spaces, yes. But I think what's also significant here is that government agencies at the federal or state level that have less sensitive data might be more willing to experiment with putting this on not just Amazon's cloud, but Microsoft is number 2 in the cloud game right now, pushing hard. So it presents lots of opportunities for those folks.
All right, John, thank you very much. John Fort reporting from Palo Alto for us tonight.
Auto sales are in overdrive, and that's why automakers are adding more assembly line workers and keeping some plants open around the clock. They also need more engineers, designers, finance professionals, and information technology experts. So today, Ford Motor said it plans to add 800 more of those white-collar workers, and that's in addition to the 2,200 new jobs previously announced by Ford this year.
Rival automaker Toyota is not likely to be adding any more U.S. jobs anytime soon. The CEO of Toyota of North America conceded that the company will not reach the 17% U.S. market share it held 4 years ago. Toyota, of course, has meantime been hit by several costly safety recalls and by disruptions caused by the 2011 Japan earthquake and tsunami. The automaker now expects U.S. market share to fall somewhere between the current 14% level and that all-time high of 17% back in 2009. That was, of course, when General Motors and Chrysler were flat on their backs.
Well, no matter what kind of car you drive, a new study finds that if you use a hands-free cell phone to talk or send messages when you're driving, it may be as dangerous as holding that phone in your hand. Hampton Pearson explains.
An estimated 9 million motorists now have some form of voice-activated technology in their vehicles. And auto industry experts say that number could increase 7-fold in the next 5 years. But a new study from AAA says taking the mind of the driver off the road can be just as risky as talking on a cell phone or texting while driving.
These infotainment systems are actually making people less able to operate or drive as safely as they would otherwise.
A team of researchers at the University of Utah wired up subjects and took them out on the road in a vehicle equipped with voice-activated technology for multitasking while behind the wheel. What the researchers found was that even with eyes on the road and hands-free, driver reaction time and ability to process information was impaired.
As we increase the mental demands on a driver while they're driving down the road, their ability to operate the motor vehicle safely is degraded.
Auto industry officials are disputing that study. A statement from the Alliance of Automobile Manufacturers says, "We're concerned about any study that suggests that handheld phones are comparably risky to the hands-free systems we're putting in our vehicles." We could be looking at a new clash between the auto industry and safety advocates. In the next 5 years, it's estimated that nearly half of all new cars will be equipped with some type of voice recognition or hands-free technology. For Nightly Business Report, I'm Hampton Pearson in Washington.
Coming up, an airline entrepreneur with a big idea, all you can fly, for a flat monthly fee. But will the business take off with travelers? First, though, a look at how commodities, treasuries, and currencies fared today. More trouble for Boeing's 787 Dreamliner, but this time it had nothing to do with the troubled lithium-ion battery system. Japan's All Nippon Airlines says one of the engines on a domestic flight just wouldn't start, and it took place just minutes before takeoff earlier today. The malfunctioning engine was made by Rolls-Royce. There were no injuries.
So how would you like to pay one price and take all the flights you want in 1 month? Well, one small airline based in California is hoping that's exactly what customers want. Phil LeBeau has that story.
It's a small plane and a small airline with big ambitions. Surf Air is an all-you-can-fly airline created by 34-year-old Wade Irely, who is charging members $1,650 a month to fly as much as they want.
This is a flat fee, all-you-can-fly subscription. So we've been compared to a country club with planes instead of golf courses. So we've also been talked about as the Netflix of air travel.
Surf Air and its trio of turboprop planes will initially fly between Burbank and San Carlos, California, in the Silicon Valley, and soon add flights to other cities in California. On board the very first Surf Air flight from Burbank up to San Carlos, there are 6 seats in this Pilatus PC-12. Decent amount of legroom, enough that you don't feel like you're cramped inside of a small plane. So far, 150 people have signed up as members of Surf Air. Do they really think they'll fly enough to justify paying $1,650 a month?
If you calculate what your time is worth during the day, if you save multiple hours during the month on waiting and checking in and parking, etc., I think it more than can justify itself.
Historically, startup airlines struggle to soar. Critics say it's too hard to make big money on small planes with a limited customer base.
The history says most of them won't work. And so I don't know where they come from. I wouldn't put my pension in the idea, but maybe some other people have more tolerance for risk than I do.
What we're doing is something fundamentally different. So while we're both using planes to move people from A to B, the business is very different. What we're selling is a satisfied experience.
One flight completed, the challenge for Surf Air now is to see if it can fly in an industry filled with turbulence. Phil LeBeau, Nightly Business Report, San Carlos, California.
Well, the U.S. Golf Association, with the help of Tiger Woods, Arnold Palmer, and Paula Creamer, has adopted Rodney Dangerfield's impatient zinger from the iconic movie Caddyshack, While We're Young, in an effort to speed up play.
Let's see, what did I use here last time? Wedge or a 9?
While we're young?
While we're young.
While we're young.
While we're young.
Behind the fun, the big business of golf is feeling some pressure. Although rounds played have picked up as the economy improves, they're still 20% below the 80s peak, according to the National Golf Foundation. And one reason is slow play. Duffers imitating the painstaking pros they see on TV.
Slow play is a very serious issue, and I hope that the golfing public gets the message.
We need to pick up the pace of play. We need to play faster.
So you'll see a series of PSAs during the U.S. Open this weekend of familiar faces sweating over putts and overthinking tee shots, with reminders for golfers like you and me to pick up the pace out there.
While we're young?
Oh, boy. I don't see you, Tyler, as a slow player.
I am
overthinking.
Fast. I don't just pick up the pace. I pick up the ball when I don't like the score on any given hole. But I'm all for moving the game along.
Yeah, get it going while we're young. That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks for watching.
And I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody, and be sure to log on to our website at nbr.com. We hope to see you back here tomorrow evening.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garrett with a Nightly Business Report news brief. Growing worries that the Federal Reserve will begin pulling back on its stimulus plans and send interest rates higher sparked another big sell-off today. After more wild swings in the markets, the Dow lost 126 points, ending below the 15,000 threshold. The Nasdaq ended 36 points lower, the S&P off by 13. The U.S. budget deficit ballooned to $139 billion in May when all those tax refunds got sent out. Applications for new mortgages rose 5% last week, and the number of underwater homeowners, those who owe more on their mortgages than their homes are worth, fell by nearly 1 million in the first quarter. And Ford is adding 800 white-collar jobs like engineers and designers to keep up with rising demand for new cars. Be sure to tune into Nightly Business Report right here on your public television station.